And welcome to today's Midday Market Update for September 10th, 2020. My name's Kevin Hill, as always, here with Michael Vincent. We have an exciting show for you today.
As always, my friend.
Markets. All about the freight markets. It's interactive as well.
It is interactive. So FreightWaves LinkedIn, right? On LinkedIn and on Facebook. Get the questions and comments in, and we'll get them answered and addressed as best we can. But like Kevin said, we got a great show today, right?
Yeah, in a few minutes we'll have Bill Driegert.
Bill Driegert will be on at 12:15. A little bit of a shakeup. We're going to go through some headlines and so on, and then we've got Zach Strickland in. Bill Driegert, Uber Freight, will be on. We've got Greg Miller. Maritime, ocean, correspondent talking about what's going on in the ocean, which lots of things happening there. Blank sailings, unblanked sailings, capacity surcharges. Record pricing, record profits, Maersk canceling Safe Marine.
We have a lot to go through with Greg Miller.
A lot.
It's on to jobless claims and the economy with our lead economist here at FreightWaves, Anthony Smith. But let's kick it off right now with the news. We have some breaking news headlines on FreightWaves.com, and the first one is the port of Beirut, where we had the huge explosion a few weeks ago. What's going on there right now, Michael Vincent?
Yeah, so there's another fire erupted at the port of Beirut on Thursday, just over a month after that explosion that killed more than 190. You saw the video of that.
Yes, I did. It is
pretty massive, but yeah, it's on fire. And according to reports, the Lebanese army said the fire started in a warehouse containing oil and tires. So not an easy thing to put out, right? Residents of Lebanon's capital city took to social media Thursday. Posts on Twitter included shortness of breath recorded in the area due to the heavy smoke. Another said the fire at Beirut port seemed to die down for a bit, but it's raging full on again now. And people in the area are that are closer say they're choking on the fumes. I mean, obviously, it's a tire fire, literally. No joke there, right?
No joke there. That smoke is thick and dense and black and it's no joke there. Beirut just doesn't seem to have any luck these days.
Yeah, they're having a rough August and September, right? I mean, shoot fire. 2,700 tons of ammonium nitrate went up on August 4th. That explosion was massive.
I could imagine. So I definitely. Switching back to the U.S. and the trucking market, split duty rest break.
Yeah, it's interesting. We were talking about that.
Yeah, we were, yes.
Right? So, they're the split duty rest break, a lever for boosting capacity, right? So the idea is, in a nutshell, is to be able to use 30 minutes to 3 hours, I think, up to.
Yeah, you have the flexibility.
Flex time where you can kind of pause your 14-hour workday. I guess the intention is for fatigue and that type of stuff, but also for dwell or detention time at a facility where you can utilize that time as rest and get more miles and move. The idea being in the survey, they said 48% of respondents in the survey, truckers, said that they were for it, and one of their main things they were talking about getting more miles. They could get up to, I think the average they were thinking like a turn and a half more a week out of it if they were to do that.
Yeah, they can get a turn and a half maybe out of it. It gives them more flexibility. Everyone likes flexibility with their time and being able to judge when they're fatigued and when they're not, instead of very concrete rules that are.
Yeah, I mean, one of the things we discussed before and have heard from others and experts in the area of driver fatigue, et cetera, was the idea of having some type of flexibility there for that end of the drive where maybe you're ending up in Chicago and that last couple hours there you're stuck in traffic sitting there, right? Why not break and be able to move on, and for safety reasons, et cetera, and those type of things make sense, but some of them look to this as being a safety hazard as well.
Yeah, definitely. And on Facebook, Jason McIntyre, good afternoon from Buffalo, New York. Good afternoon to you too, Jason. And Rhonda Bumpinsa Zimmerman, who's Director of Fitness and Wellness over at Global Trans, says, morning, fellas. So morning to you too, Rhonda. Glad you're joining us today. So if you have any questions, comments, please reach out to us via LinkedIn or Facebook, and we'll read them and address them on the air.
Yeah, absolutely. So the people who were, so they've had the comments in the surveys and, commenting on this rule, right? The open public comments as they go through this. So the ones who just outright oppose it say, lengthening the driver's day from 14 to 17 hours would cause a lot of risk of crashes, et cetera. And even Brett Sant, the Senior Vice President for Safety and Risk Management at Nice Swift Transportation, said this is patently unfair to the driver, would expose drivers to driving much later in their workday, and would jeopardize highway safety as well. So there's those that see that.
There's also go ahead.
There's the other side of this. How is it unfair to the driver if they're giving them this option? I mean, it's not forcing them to drive longer. I guess I'm not totally clear on that side of the argument.
I'm not clear on that side of the argument too, because it's all about choice and being able to take control of your time, so you don't have to be out for 17 hours if you don't want to, and if you are, then you're taking a rest break.
Yeah, it doesn't give the carriers the right to force drivers to drive 17 hours.
That's correct. And
the
then
way
you have
I
this,
understand it.
You're exactly right. And then you have this whole theoretical thing of loosening capacity and tight capacity. We'll talk to Zach here in a second about the capacity crunch that we're doing right now. But if you're more flexible, if you open up capacity, that is, by definition, increases supply, which will force rates, downward pressure on rates, however. I'm not saying,
you can gain capacity in several ways, right? Mm-hmm. Adding just straight up physical capacity,
adding drivers,
or more efficient use of the existing capacity, and that would be the argument here. Is more efficient use of this capacity would create more capacity, more turns, and therefore drive down some rates. So there's those that are on that side of the argument as well. And OIDA, they said, really rather than taking away the added flexibility from these drivers, which I tend to agree with, is why don't you address the underlying issues of the detention time in the first place?
True.
Right. I mean, we've talked to other drivers like Wayne Craig, et cetera, on What the Truck and other shows, and he doesn't have any issue, and many other drivers don't, with the hours of service the way they are. If we focus on those shippers and receivers that are making you sit there for 3 hours,
Well, I think that the one thing we can all agree on 100% of the time is that there's no perfect solution. Right? Okay. So there's no perfect solution. I think we can all agree on that. Let's talk about truckload stocks and Cowen's 13th Annual Global Transportation and Sustainable Mobility Conference that was held virtually on Wednesday. And we had a very bullish sentiment by executives from public truckload companies about the market and how long that may last.
Yeah, absolutely. I mean, you read this, and you've got like Schneider National's Chief Financial Officer, Steve, how do you pronounce Bruffett? Is that right? Bruffett. I'm sorry, Bruffett. He's talking about, he said if the company's current load tenders fell by 10% to 15%, they would still have more freight than it could handle on a daily basis.
That's a very bullish statement, isn't it?
I mean, it's a sign of what's going on right now. But like you said, many are just moving forward. Shortage of drivers, drug and alcohol clearinghouse and COVID-19, some of the PPP, et cetera, and drivers sitting on the sideline have reduced the drivers by 100,000 drivers. I mean, with all the effects, with the CDL schools, there's less coming through the schools, et cetera. Some sitting on the drive line, and then the drug clearinghouse took out 30,000 drivers or something like that. Then these things are not going to recover very quickly.
And they're not. And load volumes, and we've been seeing this data in Sonar too. JB Hunt, or Eric McKee from JB Hunt, commented during the conference that sequentially over the last 6 weeks, so he's seen a ramp up, or JB Hunt has seen a ramp up of trucking volumes week over week for the last 6 weeks.
Yeah.
That it's really getting very strong, so another bullish indicator there. So I think from all the public companies that were there, you got a lot of bullish sentiments.
You really do. I mean,
it reminded me early of 2018 quite a bit.
Absolutely.
That bullish, these bullish comments and statements.
Yeah. President and CEO Eric Fuller, President and CEO of U.S. Express Enterprises, Eric Fuller, believes that the current, what he said, he and paraphrasing here, but he believes the current demand surge is in part due to the lean inventories that existed prior to the pandemic. I think we all agree with that. He also said that COVID has shifted buying patterns, which we're seeing that, obviously, away from services and experiencing tangible goods that need to be shipped is where it's switching to. And he believes, now here's bullish, he believes current elevated demand levels have another 2 to 6 quarters before they pull back.
And that is very, very much of a bullish sentiment. Tom Wadowitz from UBS had a research note out a couple of weeks ago talking about low demand, right? Or not low demand, low inventories leading to an extended period of a truckload rally and volumes, and that's what U.S. Express has mentioned right there as well. These lean inventories gives kind of the runway to do, maybe 4 to 6 quarters.
Yeah, absolutely.
I wouldn't complain.
I wouldn't complain.
A strong shipping environment means the economy is strong.
And even intermodal, just to mention it really quickly, because we got Zach Strickland. We want to get to Zach Strickland before we get to Bill Driegert. But on the intermodal side, real quickly, on the intermodal demand, Darren Field, J.B. Hunt's executive vice president of intermodal, said, "In my 26-year career, I don't remember a time when demand was so strong for the customer asking for solutions and begging for more capacity than right now." So things are on fire, and there's really nothing that we're looking at that is saying, hey, this is just gonna die off anytime soon.
There's nothing. Intermodal market is showing life for the first time in quite a while.
Yeah,
which is very encouraging. But if we go to the freight markets and the truckload market and talk about what we're seeing on the ground, we have Zach Strickland, our director of Freight Market Intelligence, joining us right now. What are you seeing in the freight market, Zach?
Hey, thanks, guys. So, nice job on picking out the wardrobe today. I'm glad we could all get on the same page. What's interesting is that the West Coast has really kind of stalled out. Now, this has been the hot area of the country. We've watched tender rejection rates just increase every single month since about early May or so. Los Angeles and Ontario markets, of course, being at the center of that. But at the same time, it's just been constantly growing. We're almost to 30% on the West Coast right now, and they stalled out here over the last week or so. So right around that 27, 28% mark. Still very high, very tight markets, but they're kind of plateauing, and it's not real clear if this is just a temporary pause or if they're going to continue to increase. But regardless, that should have some sort of stabilizing factor on the spot market out there. Now, on the other side of the nation, we're seeing tender rejection rates increase dramatically. So the Harrisburg market, Allentown markets up there around the megalopolis, both seeing tender rejection rates up around 35%, 36% in the Harrisburg market today, and that has been growing significantly since prior to Labor Day. So it's not simply just a holiday impact. We're actually seeing this, I don't know if it's a balancing act by carriers, but as I think most of us know that have been following the freight market for a while, Los Angeles has been a really hot market, a hot area of the country to go to get, some significant spot market rates and increase your margins. So a lot of the carriers might be going out to the West Coast just to take advantage of that. We know we've talked to a lot of people that have seen rates, kind of fall going into that market just so they can get a piece of that market. So that might have actually created a little bit of East Coast imbalance, which is increasing the spot market and also the rejection rates on the East Coast.
Yeah, absolutely. And these high volume areas, like you're talking about Harrisburg, Allentown, et cetera, we're seeing those really grab capacity from surrounding markets, right? I mean, even those markets that aren't really on fire with outbound tender volumes, their rejection rates 40, 50% in some of those areas. I mean, Erie's like 40%. Charleston's really high, Kevin. I mean, there's some areas there, right, Zach?
Yeah, and that's what happens is the carriers will flock to the markets with the most consistent volume and the easiest pickings, if you will. But yeah, the Harrisburg, Allentown markets will pull a lot of that capacity because it does have a consistent amount of freight available generally, but also it has a good amount of inbound freight as well. So that leads to carriers not having to go deadhead to get to the Erie market or one of those outlying markets, if you will. And that will also pull those rejection rates up higher in the outlying markets. So we're seeing increased volatility in the smaller markets for sure, which has a double-sided effect. You could see areas with no capacity, but then you're also going to have a lot of carriers that are simply trying to just get out. So you're going to see a lot of volatility in these markets.
Thank you very much for that freight market breakdown today, Zach. And we'll move on to our first guest.
Yeah, we've got Bill Driegert, head of operations and co-founder of Uber Freight, joining us. Bill, how are you today? Thanks for being on the show.
Hey, Michael. Yeah, no, it's good to be here. I'm under a blanket of smoke out here in California, but it's good to get on the air with you.
Excellent. So, Bill, Uber Freight, obviously everybody knows who Uber Freight is. Can you just give us a little bit of introduction of yourself and what's going on at Uber Freight?
Sure, yeah. So I'm the head of operations and co-founder here at Uber Freight. Long history in the industry with operations and freight. Been very focused on technology and how it can improve freight since 2006 or so. Uber Freight was really founded to bring better technology to the market, to leverage technology to simplify freight, to really simplify the execution of freight. And the products I'm here to talk about today are really in that vein.
Yeah, absolutely. So Uber Freight really, in the beginning, the journey was really carrier focused in the beginning, right? And yeah. I guess pretty early on, a year into it or whatever, it was quite obvious that there wasn't a shift away from that, but the inclusion then to really bring added value to the shippers and solving those solutions to the shippers. And I guess that's really, can you talk to that journey? Because it seems like that's really the mission, right, is to bring the two together and be that vehicle.
Yeah, that's accurate. So early on, we recognized that the first problem that we could solve through technology was really the owner-operators and the small carriers. And there was a clear value proposition in bringing this long tail of capacity, all these owner-operators, to the large shippers. But to solve large shipper technology problems and to really bring value to them, we had to have a very liquid network. So the first thing we did was launch a carrier application and get it in the hands of carriers. And today we have the most downloads of any application in this market and the most usage. So we have this application now that's in the hands of tens of thousands of owner operators, small carriers, and large carriers, where they're checking it every day, they're executing freight, and so that really created the foundation. And then once we had this liquid capacity, where we're reaching carriers in seconds and executing freight instantly, then we can leverage that with the shippers because now they have visibility. Now we can get them real-time pricing because we had a national network. So it was really around 2018 that we started investing very heavily in shipper technology with things like pricing APIs and our shipper platform where shippers can go online and book a load and get a price in real time. But first we had to have the carriers, right? So first we had to have the foundation and the capacity, and then we could start to leverage that for more advanced tools and more advanced procurement and execution technology with our shippers.
So Bill, with that technology, how do you envision shippers to actually use the platform? Step by step. Yeah. Kind of what are the main benefits, I guess?
Yeah. So the big announcement this week is we have two new products that we're launching. So we have Uber Freight Enterprise, which is more of the umbrella platform. Uber Freight Enterprise is really an extension of the shipper platform that we already came to market, but more tailored for enterprises. And it gives more control on prices and execution, more visibility, real-time ETAs, document management, everything that you would expect from an execution platform. We also announced our Link product. Link is a little more interesting in the sense that what we've done there is effectively empower our shippers with that app technology, with the execution layer technology. We think of it as a new space because, like I mentioned, we're the first ones to have such a broad coverage of app adoption within the market. And that allows us to then execute freight, tender freight, get instant acceptance. So if you think of it in the context of traditional transportation technology, a shipper can tender a load and have a driver see that load within seconds and accept it versus going through a traditional kind of waterfall execution methodology.
So that link, that like you said, and I agree with you, that's more interesting to me, is that link really takes out the voice broker completely. Is that right?
It does. Effectively, our shippers have been asking us for this for a while, since they see that we've got this execution capability. They see that we can reach our carriers in seconds and that we have loads getting booked at one touch. And so then comparing that to traditional ways of tendering and everybody's familiar with the long process of going through the waterfall, all the manual touch points involved in that versus just reaching out to the carrier directly on an app. It's a very different execution process. So yeah, it's effectively empowering our shippers with a lot of the technology that we've built internally that have made this marketplace so efficient for us.
So on the flip side of that, Bill, empowering shippers, how are the carriers, reacting and participating? What are their attitudes toward this platform as well?
I think carriers have always appreciated the simplicity of what we bring to the market. And when we talk to the carriers that are very close to these shippers, they like the fact typically we're working with shippers that may not have great tech on the carrier's hands. So the carriers really didn't have anything before, or they were just accepting loads via email, fax, and phone call the traditional way. So the carriers very much appreciate it. There's always been a strong product market fit on the carrier side because they get to run their business on their time and their schedule, and they get all the information in their hands. They don't have to be sitting at a computer or kind of wait for a response, and it's all just instant. And that's actually was one of the early points of feedback that I think got us excited about the opportunity, is that when we actually went and talked to the carriers, they were very excited to have better technology or just a better way of interacting with shippers.
Yeah. So, Bill, you guys have had a lot of partnership with different TMS providers, et cetera. Does this new link and enterprise put you in direct competition with those partners?
No, we don't think of this as a TMS product. It's much more of I think of it as a new category of product, which is really execution layer technology. Mm-hmm. And that execution layer really is all about the tendering. So it can plug in and work with the TMSs. And yes, we partner with TMSs quite closely. And it really is all about how do we simplify that process and take all the friction out of that final tendering and execution step. And then through that, we now have greater visibility for the full load lifecycle, because of the carriers then using the application, we have perfect visibility throughout the whole life cycle. So you get that added benefit as well. And it really solves that post-load planning, post-tendering, post-knowing which load is going to go to which carrier. How do we then streamline that whole process?
So, Bill, the technology sounds fascinating, but it's all driven by the data. So there's a lot of data that's going to be flowing through this technology. You're going to be collecting it. What's the play on that?
Yeah, so there is data that will be isolated within just the link, the enterprise platform. I mean, we're not going to have the brokerage won't have visibility to prices that the shipper has directly with the carrier. That information will be isolated. The carriers, of course, if they have the app, they have access to, we can enable them through additional backhaul opportunities and keep them moving. And there's a lot of added benefits to them as well for being just engaged in the platform. But from a data separation, we're very mindful of the fact that if a shipper has a good relationship with the carrier, we want to make sure that that is maintained and that information is separated, and that we're not leveraging that on the other side.
Yeah, the days are certainly gone of it being, hey, I've got relations with 20,000 carriers. Can I, in my bullpen, can I have your freight? Yeah. Right? It's all these added solutions, and these are two excellent ones, obviously. And so what's the play moving forward as you roll these out? I mean, this is an excellent strategy that you guys are moving forward with. What's the future hold?
Yeah, no, it's a great question. Like you said, we've got partners lined up and many of which have large carrier bases that are excited to get to leverage this tech to be able to reach those carriers. Because if the deeper your carrier base, as you know, the harder it is to manage. And there's always a trade-off for a shipper in terms of how deep your routing guide is, right, and how much complexity you want to bring to your transportation department, and how many deep that department needs to be. And this allows our shippers to really kind of scale up their reach and their capabilities and their ability to access their carriers quickly, to drive resilience in their supply chain, to drive efficiency, to get better pricing, to get better execution, greater reliability. For us, we just launched this product, so the next step is really getting it out to market and working with our shippers and continue to expand it and take that feedback and build on top of that. But we've got a pretty good initial set of customers and partners that we're working with to get this to market.
So what are the plans for, you said next steps, but what's kind of in the pipeline for working out in 2021, right? 2020 now, right?
We are in 2020.
We are 2020. So 2021, any future product launches on the horizon or things that you guys are working on?
Yeah, we're actually holding our shipper conference this week, and so this hence the timing of this announcement, which is a pretty large one. The other one that I'm pretty excited about is we actually are launching today what we call Rate Lock product on our shipper platform, which is our first foray into real-time contracted rates. And I'm a huge believer in our pricing API and the idea of instant rates in the marketplace. And I believe the future is that all rates will be generated via API, 1 day, 2 day, 3 month, 12 month, and those will be then matched to the decision that a shipper is making when they're making it. I think we've seen in the market, particularly right now with all the volatility, that the whole RFP cycle is coming into question, and shippers are very hesitant to make like RFP commitments right now without knowing what's going to happen in 6 months. And I think that then just reflects the need to have more options in how shippers price and more instant access to information and contractual rates. So that is one product that's coming out right now as we speak. That is actually a very exciting next step in the evolution of pricing in the market. And the other piece of that is we've seen our API usage just explode. So on the pricing and procurement side, I think over the next year, we're going to see a dramatic shift in just how shippers think about it. And we're hearing that from our shippers, and we see it every day. And a year ago, there was really no usage of any pricing APIs by any shipper. And today, we have hundreds of shippers, and almost every TMS is now providing real-time pricing in their own platforms. And so that's been a dramatic transformation that over the last 12 months, and really this COVID crisis has just accelerated that.
Excellent stuff. Really interesting stuff. And I mean, it's always exciting to watch this industry evolve, right? Where it's been 34 years ago when I jumped into it, but it is quite amazing. And Bill, really interesting stuff there. I really appreciate you coming on the show. Hopefully we can do this again really soon.
Yeah, absolutely. It's always good to be on here.
Thanks, Bill.
Thanks, Bill.
Michael.
Yeah, we have some viewer comments here. Tom Curry, good friend of FreightWaves there, the Senior VP of Strategy and Innovation at Kingsgate. I love the concept of a split duty break. I think there's a big win here for the drivers. They want flexibility most of the time. Some may oppose because they just want it destroyed, but I think this is a step in the right direction.
I'm kind of with him on that comment.
I am too.
Tom Curry's pretty sharp guy, as we all know, and I'm kind of on that. Why not give him that? Like OIDA even says. I mean, you give him the options. Let's fix the problems where those problems are and where those root causes are. Not take away this option that the drivers could really use.
Yeah, it's all about optionality.
Yeah,
and optionality is usually very good. Nico Brown, fleet operations consultant. Do you have any data on how many times on average a company will accept you're rejecting their freight before they look for other carriers? And I think this is probably a macro type of issue and service level driven. So it's gonna fluctuate between shipper and shipper, right? No two shippers are alike. So
they're not, and it's a relationship that you have and what's going on there. Yeah. I mean, in my time as a broker, it was just enough to not really make them mad.
I was about to say the same thing. If they think you're rejecting too much, you're rejecting too much, and that could change day to day.
Yeah.
And then Rob Bussey, hello guys. Not totally tied to the transportation market, but do you see manufacturing picking up a Q4 or not until early 2021? And about 15 minutes, we'll be talking to Anthony Smith, and he will answer that question.
We will come back to that one for Anthony Smith.
We definitely will. So, but we have our next guest on the line here, and that's Greg Miller, our senior editor of Maritime here at FreightWaves. How are you doing today, Greg?
Good. Thanks for having me. How are you?
Doing great. Doing great. So you cover the ocean markets, the maritime markets. It's a hot market right now, isn't it?
It is a crazy time right now. Record rates. I mean, if you think back to late March, early April, people were talking about the container business losing over $20 billion. People were talking about liners going out of business. People were talking about 30% volume drops in a month. If you said back then that in September, rates from China to California would be 3,700 per FEU, and to the East Coast, 4,500 per FEU. And if you were to say that August import volumes would be record volumes, people would think you were crazy. No one predicted any of this.
No, they really didn't, did they, Greg? I remember reading about, they're going to start blanking, I forget the percentages of sailings, but massive amounts of sailings were being 15 just to try and survive. Hopefully we can survive if we do this, right?
Exactly.
And so what has happened since then?
So what happened is they blanked too many sailings. It turned out there was more demand than they thought, so they unblanked the sailings. And then for the third quarter, not only did they have all of their capacity back, but they've added in about 13% of additional capacity. And even with all that capacity added back in, the demand is higher. The demand is higher for many reasons.
Do you think some of those reasons are playing catch up with all the freight that didn't move out of Asia because of the pandemic, or do you see that this this bull market has legs?
Well, some of it is catch up, I'm sure, but a lot of it is also the switch to e-commerce. I mean, whatever you're losing on the storefront, you're getting from e-commerce. You have PPE coming in. There is some volumes coming forward because of Golden Week. So there's a bit of that. And there's also a lot of people that are moving from the cities to the country. And when you move to the country, when you move to a house, you have to buy things. There's a lot of people that are not spending money on vacations or as much as they would at restaurants, and they're still spending the money because the government support's still there. So the question is exactly, is this the peak here? And is this going to pull back towards the end of the year as the government support pulls back, assuming it does?
So, Greg, I'm interested in maritime. I love maritime. I was in it for about 8 years in a very specific market in the Caribbean and Central and South America. But when we talk about the maritime, we talk about these volumes. Is it across all lanes? Is it in specific lanes? Is it just China to the West Coast, or is it across the globe that we're seeing this?
There is an increase, but it's much more across the Pacific, specifically to California, than taking the long route through the Panama Canal to the East Coast. And it's also much less from Europe to the East Coast. So it's really the West Coast that's benefiting. There seems to be a focus on speed and getting things from China to California. That's the fastest way to do it.
We've seen some, Maersk being one, restructuring, and then ocean lines. What's really the driver on that, Greg?
Well, that was interesting. That came out last week, and Maersk, they put their reports out in the middle of the night, New York time. So by the time you wake up, you see the news, and the immediate response from the media was, okay, Maersk is going to be cutting thousands of jobs, ergo coronavirus damage. Jobs cut, just like you saw with in the hospitality industry and airlines and banks. But really, it's not as negative as it first appeared. Maersk went into this idea of restructuring back in October before the pandemic, and they were originally planning to implement it in May. And so they pushed it back till now as a result of the pandemic. But the reason they're doing it now is because they feel much more comfortable with the situation. I mean, they tripled their quarterly profits in the second quarter. So it's not so much cutting jobs, but strategic plans that they had made and they wanted to implement to streamline their operations. Basically cutting the SAF Marine brand and folding that into the Maersk Line brand because there was so much overlap, and taking the air cargo and LCL freight forwarding business of Damco and putting that into Maersk Logistics. So their argument is that they're not doing this to cut costs. They're doing this to streamline their operations.
Yeah, that makes sense. So early on, they were. I mean, as you said in the article, and going through this, these were plans all along, and it's not a bearish move. It's a bullish move. So I guess they just feel more comfortable with the volumes that are there and the profits that are going on. That I guess the risk of possibly losing customers over this move is now something they're more willing to take. Is that accurate to say?
Yeah, I guess so. But at the same time, one also has to be a little bit cynical. So the truth is probably somewhere in the middle.
Gotcha. So one of the stories that you recently wrote that is on FreightWaves.com, and we're talking about the shocks to the systems in the McKinsey report, right, and how it relates to importers, et cetera. And that's one of the things that really caught my eye is this changing strategies in light of COVID, really, and what that next disaster might mean. So it's almost a future-proofing type of thing, I guess they're talking about. Can you speak to that a little bit, Greg?
Yeah. So McKinsey started a research project actually last year. Same as Maersk, they started this last year before the pandemic. This wasn't about the pandemic. They had this idea of looking at supply chains, risk and resilience, and they looked through a whole gamut of potential shocks and disasters, whether it be dirty bombs or pandemics or wars or meteorite strikes. But they were basically saying that global supply chains are more vulnerable to risk because they're more interconnected and more global. And their idea was that these risks are going to increase over time, and so shippers need to adjust. And just as they were putting this report together, here comes the pandemic. So right in the middle of researching the report, they had the actual pandemic happen. And the pandemic, I think, provides a little bit more impetus to the shipper community to finally make some of these changes. And the report went into a variety of strategies, and a couple of them are particularly relevant to ocean shipping. One would be regionalization, or bringing the supply chain in closer, reducing the distance that the ships have to go, and increasing the speed to market between the manufacturer and the consumer. And another idea would be inventory. So instead of changing your supply chains, you just bring in more inventory as a protection, as a defense. And so the question is this going to happen in the future? And is some of this happening now? I mean, you asked me before about these volumes that we're seeing in August and September. And perhaps some of this is people that are putting in these inventories, defensively now. Shippers in the United States, retailers.
So kind of speaking to the just-in-case model instead of the just-in-time, right?
Yeah.
Yeah,
absolutely.
That's kind of the shift that we're talking about, and is this increase in volume in part due to that?
Yeah, and we're seeing that in the truckload market. We've been hearing about it in the truckload market. Yeah. One of our top stories was talking about low inventory levels and trying to replenish those and probably becoming more just in case. And, what we've seen in the ocean market is kind of what we're seeing in the truckload market with the DHL Supply Chain Pricing Power Index up to 85, which is very much in the carrier's favor. And a lot of that is port traffic or right. goods coming in from Asia. From your sources, Greg, what's the outlook for maybe 2021? I mean, is it pretty bullish for a long term or the medium term, or what's the sentiment out in the market?
Well, it of course depends. I mean, this all goes to whether you believe that there's another shoe to drop economically. If you believe that government support will continue and will cover over the debts and the unemployment that have been generated over the last couple of months, then you're going to be pretty bullish. There's also the idea that the bill is going to come due. I mean, the question is how big is it going to be and when's it going to happen? But there is a rising level of unemployment, and there may be a decrease in the government support. So we could see a decrease in some of this consumer spending that we saw over the last couple months, and therefore it would be negative. So it really depends upon what the secondary effects are going to be.
Yeah, it definitely is. And a lot of comments here on LinkedIn. Greg, complimenting your bookcase. It is quite a bookcase that you have behind you.
Thank you. Well, they say it's supposed to be a clear white background, and I've failed. Let's hope it's not HD enough where you can see which books I have.
I hope it's not either. We have a teleprompter, so we can barely make it out little bit.
Is that Nancy Drew I see up there?
Nancy Drew, yes. Well, thank you so much for your time today, Greg. Always a pleasure talking to you. How does our audience contact you with ideas for stories or talk about the ocean market with you?
Well, gmiller@freightwaves.com. Get in touch. I'm always looking for stories.
Okay. gmiller@freightwaves.com.
G-Miller.
G-Miller. And he's very
Always
active on
great to
Twitter,
have him
too.
on
I wish he'd given out his Twitter ID.
Oh, yeah. Okay.
Yeah.
Great.
Yeah.
Excellent.
It's
No,
very,
good,
very
really
entertaining
interesting
tweets.
stuff, right? To go through the maritime and see what's going on and see how the world is doing it, and I think it's interesting to speak to those volumes. And is it just in case, or isn't it a just in case type of movement of volumes that are coming in? And still the same question: Will there still be that economic support to keep this movement going, or will there not be one? Is interesting, and you know,
and how we know inventory levels are depleted. I mean, what are the thoughts of rebuilding those? Are those to rebuild to send back out for e-commerce, or is there a plan?
I think right now it's flowing through. If you look at the outbound tender volumes indexes, and you'll see that all lengths of haul are still growing, right? And you'll see those fluctuations. And right now, we're seeing that long haul and tweener and mid is real high, and city and local or short is still going up, but not quite at the exact same pace, right? And so those coming up. They're still growing, so it's flowing through the warehouses still. Will that continue, right? Like Greg said, is the bill going to come due, or is it?
Yeah, and it sounds like there's not enough capacity out there, both on the ocean side, the air side, and also the trucking side to really build up inventories right now. It's hard to get everything here to build it up before it gets sent back out or gets sent downstream.
And you have people of very, very large logistics and carriers saying if we lost 10 to 15% of our volumes today, we still couldn't cover it all.
Yeah, it was really interesting. Greg came up with about the same numbers almost, that they've reinstated all the selling. So at full capacity, add another 13%.
Another 13%.
And still can't meet up with demand, which is 10 to 15%.
It's exactly right. And who's it? Chris Richards at Steam Logistics was talking about the exact same thing. They can't keep up with demand. They've got sleepless nights there. There is Steam Logistics International Freight, bringing in the freight brokers. But he's really bullish. Now, Chris was really bullish all the way through this year.
Yes.
He thinks it's just going to keep on flying, is what they're seeing, and from his.
Yes. I wonder if economists are bullish. And we had a question on manufacturing, so I'm going to ask Anthony Smith.
We have ones as big as a bull.
I know, right? I'm going to ask, Anthony Smith, our lead economist here at FreightWaves. Manufacturing, what's the outlook for manufacturing?
Right now, the outlook for manufacturing is pretty strong. We're looking across the board. Although there is a recovery in place right now, it's still below year-ago levels. But when looking at a month-to-month movement, there is some upward momentum, especially when we're looking at survey-based data like the ISM PMI. The new orders component is well into the 60s now, so well above that 50 growth threshold mark. And so that's definitely showing some encouraging signs when you lay that across industrial production, which are tangible results. There is a close correlation. So those new orders components are really ramping up. Production is looking good. Respondents within the survey were noting that domestic production is looking good when we're looking at fabricated metals. Paper products, which is a little bit of a mixed bag domestically. We're looking at across the board on really a lot of the industries. Manufacturing is looking pretty strong right now from a month-to-month basis. Still below year-ago levels, but looking good and promising so far. The main laggard right now within manufacturing is coming from employment, which is still below that 50 threshold, I think somewhere around that 44, 46 mark. And so that's still lagging behind. And I think that's going to be one of the areas that's going to be hard to come back into when we look at manufacturing. When we're looking at overall manufacturing, I think, of course, this is going to be a changed environment overall. So we might see more automation being pushed, more technology, of course, as always, entering the space. Internet of Things was always ramping up within manufacturing before COVID, but I think we're going to see a lot more technology enter the field, a lot more automation to kind of limit that human interaction standpoint.
Does that manufacturing employment include warehousing employment inside there, Anthony?
I don't think warehousing is included in that. I know with warehousing, we do have a measurement from the Logistics Managers Index, which shows that warehousing is very, very tight right now. We're looking at warehousing capacity, and we're looking at inventory levels. Also, the other thing that's really propping up the LMI right now, because that's also broken down into different components, is transportation prices. I think when speaking with Zach Rogers over at Colorado State University, the main thing he mentioned in a phone call was that if it wasn't for transportation prices, the LMI might just be flat right now. So that's really kind of giving a lot of credit to what's happening right now with transportation capacity and how much that's really increasing rates. But back to your original question, warehousing is very tight right now, and I can only imagine that that's an industry or that's a subsegment that's actually really ramping up a lot right now, especially when looking at downstream, closer to those retailers.
Yeah, it sounds like the LMI has finally caught up with what truckload carriers are seeing, what we're seeing in Sonar with contract pricing, going back to the Cowen virtual conference from earlier this week and talking about 10%,
right,
maybe 10% contract pricing. We've had a couple years of lowered pricing, that historical 2017,
Correct.
2018 with double-digit rate increases. It looks like we're on the verge of seeing that again. And
if it stays strong through the fourth quarter,
10
to 20% rate increases are not out of the question.
It is not.
No, I mean they're already talking. They're already talking in that conference. They were already talking about shippers already reaching out, trying to lock in rates, right? Mm-hmm. And I think maybe carriers are thinking, let's talk in a month.
We got time on our side. We got time on our side.
See where they grow.
And it's Thursday again, so we do have initial jobless claims.
We do,
and we have relatively good news on that today, right, Anthony?
Relatively good news, I think, is really kind of essentially flat from last week. So when we're looking at jobless claims, I think it came right around the mid 880,000 mark. So relatively unchanged from last week. Of course, last week was the first time that they moved to a new adjustment for that measurement. So now it's under a new process for accounting for jobless claims. So we are still seeing some steady declines overall. It's still under 1 million. We're looking at a seasonally adjusted basis. Continued claims are moving in the right direction, but also still very high overall. We're looking at pre-pandemic levels. So we're looking at jobless claims moving in the right direction, still kind of stubborn at that mid 880,000 mark, slightly above what most analysts and economists expected. I think here at FreightWaves, we were expecting some potential upward movement overall for jobless claims this week. I think we're looking at that. It's still going to be one to watch, even though we are in the midst of a recovery. I think continuing claims are going to be the main indicator to watch in the coming weeks to see how many people are still continuing to apply for jobless insured benefits compared to initial claims. Also, of course, we had the unemployment rate, which was released a couple of weeks back. I believe last week was at 8.4%, so below that 10% threshold. I think across the board, or a lot of industries, we're looking at a participation rate in the lower 60%. So we are starting to see some movement in the right direction, but still stubbornly high overall. And we're looking at a week-to-week basis.
So coming into September, what are you on the lookout for? What are your leading indicators that you're going to be anticipating in the next week or two, economic releases that you're going to be glued into?
Definitely. So over the next couple of weeks, I'm going to be keeping my eye on those regional Fed surveys, because that's going to really give us a lot of leeway and an index for what's happening on the ground on these regional bases. So looking at the Empire State, of course, Kansas City, Dallas Fed. So looking throughout the country at different manufacturing surveys on a different regional basis, just to kind of see what's actually happening within those particular states and areas. Also going to be looking at any kind of consumer data, so looking at consumer confidence as always and consumer sentiment to see how the consumers are feeling. Some see those as lagging indicators. It's a good barometer to see how optimistic a lot of consumers are going to be feeling. On that, I will also be checking out the Home Purchasing Sentiment Index from Fannie Mae, just because the housing market has been so strong as of late, just to kind of get a little bit more dive into what's happening actually on the demand side. I think a lot of it's going to be, when we look at housing, is propped up by the supply side of things, although the two have to work together. But on the supply side, we are seeing a lack of inventory on both the new homes and existing homes. So I'm wanting to see what's actually happening on that demand side for those entry-level homes and those new and existing homes as well.
Excellent. So we saved a viewer question for you because, quite frankly, we couldn't answer it.
With the manufacturer?
Yeah. No. Yeah.
Yeah. Go ahead.
Well, through Q4 and Q1, do you see? So Rob Bussey, hello guys. Not totally tied to the transportation market, but do you see manufacturing picking up in Q4, or are we waiting until 2021?
I think we're looking at manufacturing. There might be some continued upward movement into Q4. Q1, I think is going to be, I'm not as optimistic as Q1. We're looking at manufacturing, and especially when we're looking at consumer activity. I think when we're looking at Q1, there's going to be a lot of understanding after, of course, we are in an election cycle. So I think there might be some hold-offs on any type of capital gains, capital expenditures on that front. But I think up until Q4, we'll see some upward momentum potentially sustained for manufacturing. Q1 might slow down a little bit more. But I think once we see what's going to happen with this election cycle, I think a lot more businesses will have an idea of how they're going to operate and move forward in the coming year in 2021. But of course, Q1, I'm not as optimistic as I said for the consumer side of things overall.
Thank you very much for your time today, Anthony, and the economic insights. I will see you again here on the Midday Market Update well, we won't be here Tuesday because we are gearing up for our next virtual conference, aren't we, Michael Vincent?
We most certainly are.
In just a second, before we get into that,
okay.
I got Steve Cranning, Director of Logistics at X Global Inc., replying back here in the LinkedIn channel. To give you an idea of just the rate difference, we're talking about kind of ocean, going back to Greg Miller.
Okay.
Give you an idea of just the rate difference that will force a shift. Current spot rates to U.S. West Coast from base ports are at $4,000 to $4,500. Previous inland to Chicago was under $3,500. So it was base ports in Asia to Chicago is $3,500. Just to the West Coast now, it's $4,500.
So port to inland was 3,500. Now port to port is actually higher than what that was.
Yes, exactly right.
Wow.
Yeah, so it's a very much of a bull market. But yeah, next week we have our next FreightWaves virtual event, and
we do.
Let's hear all about it, Michael.
Let's hear all about that. So yeah, it's the Global Trade Tech presented by American Shipper, September 16th through the 17th. Another virtual event, and they're awesome. Dooner and I will be at the live desk.
You will,
right? And lots of great stuff. So really, Gene Soroka is one of the keynotes, who is from the Port of Los Angeles, which will be really interesting to talk to him. I mean, it's global tech, right? Global trade technology, and obviously, Port of Los Angeles plays a little bit of a part of that, right?
So they play a little bit. Los Angeles and their neighbor over there, Long Beach, they play a little bit part of ocean trade, don't they?
They have a little bit of effect on what's going on, and it's really good stuff. And so, the event is obviously, it's going to feature a lot of quick fire demos of the latest technology, and obviously the inspiring keynotes from the industry and business leaders, and really a smorgasbord, if you will, of influencers, investors, and supply chain experts. It's really going to be good. So, the mix is going to be great, and it's going to keep everybody on the cusp of the latest trends. And if you haven't done our virtual events, go back, look at them. Come to this virtual event.
Come to a virtual event. Always a fantastic
it really is.
Method for networking. Totally free to attend. Doesn't cost you anything. Have it up while you're working. We have a Slack channel dedicated to just commenting about the conference, about the talks, about the exciting demos of new technology for the global trade sector. And it's always a fun, fast-paced 2 days.
Yeah, it absolutely is. And let me tell you this, you don't want to miss the latest episode of anything, Supply Chain Spotlight, et cetera. But be on FreightWaves TV, and you can catch all of our shows there. But what I did miss put that coffee down yesterday because I had an appointment. So
you did?
Yeah, and I wanted to see it, but...
So yesterday, Tuna and I had a conversation with Liz Wayne from Able Transportation, and we talked all about selling on reputation. Increasing your reputation, doing things that increases your reputation, because I don't know if you know this, Michael Vincent, but freight brokers they don't always have the best reputation.
Get out of town.
Yeah, I know. It's shocking. It is shocking. There's gambling going on in here, right? But there's ways. So there's really great brokers out there. And it's really how to communicate that to the market.
Do the right thing and make sure
and communicate that out to the market, to your shippers, to your customers, to your carriers. So it's an art form on that. We talked a little bit about Borat and Dune, which I guess don't go hand in hand together. But you can catch that on Freightcast, on the audio version on Freightcast, anywhere you download your podcast, and as always on demand at FreightWaves TV. And that website's tv.freightwaves.com or Apple TV or Fire Stick or Roku or however many others there are out there. We're on them.
Yeah, we're out there. You can find it. So, yeah, I'm going to go back and watch it. I'm going to watch it today or this evening. I'll probably go back and watch it because it's one that I really enjoy that show.
And Anthony was talking about during the economic thing, automation and warehousing, right?
Yeah.
So we had Ben Gordon on Great Quarter Guys.
Oh, that's right.
On Tuesday, Andrew Cox and I, and we talked a little bit about robotics. Sarcos raised a big round, I think $40 million this week, and it's kind of the RoboCop or Iron Man suit. Where
I love those. Yeah, right. You ever see Edge of Tomorrow?
Conversation.
What is it? Edge of Tomorrow?
Yeah, Edge of Tomorrow. Right? Yes, exactly right.
Fighting off the aliens. Yeah. Very cool stuff. Yeah, Dooner and I were hoping to get a couple of those and just do a battle right here. Yeah. It'd be kind of fun.
So what's on What the Truck Tomorrow?
Yeah, What the Truck Tomorrow is a huge show.
Huge.
Let me tell you, massive.
The ginormous.
It's ginormous. It's ginormous. So the future is now. We've got Shelley Simpson, the EVP and Chief Commercial Officer, President at Highway Services at JB Hunt Transport, on elevating women in business and reducing emissions. We've got Jamie Hagan, owner-operator from Hellbent Express, LLC, on Maconomics and the quest for 10-plus miles per gallon, and maybe one more very special guest that we're still confirming right now.
But Shelley Simpson, that's definitely
that's enough right there.
That's A-list transportation celebrity. That's going to be a great interview.
It really is. And then this other guest that we're confirming would just it's already going to be on fire as a show with Shelley Simpson.
So tune in tomorrow at 12 p.m. Eastern Time for What the Truck. So are you a buyer of the Sarcos, of the exoskeleton? The robotic, would you use it?
Yeah, absolutely.
Yeah,
I think so.
Yeah.
Why wouldn't I use it?
I would too.
I certainly would. It would save your back, save your knees.
Yeah.
I
think safety really plays an issue.
That's what I'm talking about.
Really
the safety aspects of it, and you can. Does it make you stronger as well?
It does. You can lift like hundreds of pounds.
Well, I could do that anyways.
Human strength. I know you already do that. I've never been able to lift hundreds of pounds, so I definitely would jump in there.
Fling cars around and stuff.
I haven't done it yet.
So no more need for forklifts. Just pick that pallet up and.
I know, pick it up, and there's a lot of heavy industries out there that are very dangerous workplaces.
Absolutely,
moving equipment around.
It's no joke. We joke about it because it's fun, and it'd be fun to get a hold of those and kind of have a little competition with them. But
I imagine the WWE might buy a couple and have have a great wrestling match. I'm sure Dooner would tune in there unless he's reading his Witch of Warcraft books. So, but
very nice.
But thanks for joining us today, and we will be back a week from Tuesday. Next week again, Wednesday, Thursday, September 16th
It
and
is
17th.
Tuesday. We're not on, and we have the virtual event
It's a
Wednesday
virtual
and Thursday.
conference,
Right.
so tune in for that. Register it free. Just go to FreightWaves.com.